everybody, welcome back to the channel. If you are new around here, welcome, and if you are a returning subscriber, thank y'all so much for coming back. I do appreciate all of you guys being here. We are a family of 5 and we are trying to achieve something called FIRE, which is financial independence, retire early. We're trying to retire in about 5 years at age 42 to be able to start our own businesses, be able to go on vacation whenever we want, just really focus that time on whatever we want to do. So if you want to know more about investing, real estate, net worth, cryptocurrency, just all the real ways to level up your money with real numbers, because I show real numbers around here, subscribe to the channel, like the video, and join us. And to all my investie besties who are returning, thank y'all so much for coming back. I do appreciate all of you guys being here. So today is the long awaited video. So I'm going to be sharing with you guys our plan on what we're going to do with that $50,000 that we had earmarked for our third rental property. Our pre-approval failed, so let me just give you like a recap. So we initially applied for a pre-approval back in March, and we got the pre-approval, no problem. We figured, you know what, let's get a head start before the housing market gets crazy. And what we didn't realize is that it was already crazy then, and the inventory was insanely low, and at that time interest rates were low as well, about, I would say, like 4% for investment property. So this is another thing. We were trying to get an investment property pre-approval. So the interest rates on investment properties are always much higher than pre-approvals on primary home. Why? Because the banks view it as a riskier investment, a riskier process, because if things happen in your life, you will most likely 9 times out of 10 take care of your 4 walls before you would take care of like an investment property. And the bank know this, and as an investor, I mean, if we're being honest, we know this too. We will take care of the place we sleep versus like a business entity, if that makes sense. So we got started right away. We talked to our mortgage broker. They already know what we're trying to do. We talked with our realtor. We kind of like ran and got started, and actually made a couple of videos about it. I did like a home series. I talked to you guys about what to look for with terms of buying whether it's a primary home or an investment property, because it's really important. I talked to you guys about what to put down. I talked about home closing costs. I even took you to an open house with my husband and myself and did a tour as well. So check those videos out. But we went and saw many houses. We put offers on a couple of houses. And remember, our mindset going into this process was, this is a business. This is not a place where we're going to live personally. So we don't want to overbid on something thinking we can ride it out because we're going to live in there. We're not falling in love with any real estate investment. We're looking at what is included, what was fixed up or repaired or updated. Could we rent it out for the price that we wanted to? And was the market, in terms of where this rental house is located, could it sustain itself over time, right? And so we found a great area. We have actually a property in that area. So we're like, okay, this is fine. But when we saw like open houses, and even when we went to put in like a request to go see a house, how it was always like booked up or almost sold out, if not sold out, in terms of like, you know, the time slots that you can go and see a house. And when I saw that people were putting in over $20,000, $30,000, $40,000, and I know, you know, the area that we're looking in, because we have a property there, the houses are not worth that much technically. But again, it's not about what I believe. It's about, again, the demand of whatever it is that you're purchasing. And so we were thinking like around May, like we may get priced out of this. We were heading right up close to our pre-approval expiration date. So again, if you get a pre-approval, look at the bottom of it. It's going to say you have to have a house under contract by this particular date. If you do not, you have to go through the process over again. Well, we did not want to kind of run our credit again. So we ran this past the mortgage lender, and they said, you know what, we'll give you some extra time. So they extended it out a month to like June 17th or something like that. We said, okay, you know what? It's the summertime, it's coming, you know, we're going to see a whole lot of homes come on the market. We were really pumped about this. And I'm telling you guys, it almost seemed like as the weather got warmer, the inventory kind of got lower and lower and lower, which is kind of interesting. And then at the same time, you had the Fed increasing interest rates as well. So interest rate is very, very important when you're buying a home, because the higher the interest rate, that means the less home you can actually afford. That means the higher your payment is going to be. So when we saw that for investment properties, it was like hitting 7%. And we're like, oh my goodness, this is hitting our bottom line. We really started to look at other alternatives for this money, because we didn't want to just keep it $50,000 sitting in Capital One. It was not what we earmarked this money for. We had an emergency fund. We have our sinking funds, you know, things like that. So we didn't want all that money just sitting there doing nothing. So a lot of you may be asking, where did the $50,000 come from in the first place? So my husband, who works in the biopharma sector, he is an executive at his company, and they get really, really good bonuses. You know, all the vaccines, all the clinical trials, everything that's going on out here. Well, there's companies that actually manages and facilitate those processes, and they get paid very well. And they also get bonuses as well. And so he has been getting his bonuses every year for the past several years. And so what we've done in the past is like pay off debt, get caught up with, you know, bills and things like that. We started to buy a home. So now we're in a place where we feel like we need to do something with this money besides just let it, you know, sit in the bank account. So $30,000, I'm looking down at my notes. So $30,000 came from his bonus, and $20,000 came, we did our cash out refi on our first rental property. So we're using an asset to buy another asset. So we combine those two together. And this is after like we pay taxes, a lot of taxes. Okay. We give money to our church, and we also did some other things, like we put money aside for my daughter's Sweet 16, which is, the price has gone up on that, y'all. Okay. I'm like, a mirror photo booth. Like, she wants a mirror photo booth. These things are $900. Let me come back. But we're going to pay for it. But, you know, this different things like that. So that's what we earmarked. So that's how the $50,000 kind of came to be. But I talked to my husband, and we were like, you know what? Our bottom line, if we were buying rental properties, just so that you all know, is $500. After we pay for the mortgage, after we deduct expenses and saving and all of that, we want to walk away from our rental properties every month with $500 in our pocket. One of our rental properties we walk away with $700, and the other one we walk away with $625. So we were kind of doing pretty good in terms of what we could walk away when it comes to after, you know, the rent was paid, the mortgage was paid on the property, you know, insurances, taxes, things like that. So with this third property, because the interest rates kept going up, we were looking at pocketing about $275, $280. And I can tell you guys, investing in real estate is passive, you know, for the most part, but there are times when you actually have to put some work into it, and those few times is very pricey. We had to replace 2 roofs, we had to replace an HVAC. Anytime something happens in the house, and we're not slumlords by a long shot, okay, we're actually really good landlords. We go and we fix it, and we fix it right. Okay, we get warranties, the whole bit. So when something happens, though it's small and few, it costs, you know, a lot of money. So we were thinking, you know what, this is not worth it, paying this high interest. Now it's 8% interest that our lender is quoting for us, because the government, again, keeps pushing up the interest rates. We're doing this for an investment property. So we're looking at, I'm not editing this video either, so if you see me looking off, I'm just kind of doing this from memory, though I have like a few bullet points down here. I'm just trying to go off of this in memory. But we were thinking, okay, 8% is high, and yes, we could refinance, but again, this is an investment property for us. So 8%, after we pay everything, we're walking away with about $275, $280 a month versus the first 2 properties. And we were thinking, my husband was like, I don't know if I really want to go through this, because if this is a business, we want to look at what's going to give us the biggest return at the end of the day. So we were talking about, like, what if we put it in like a dividend company or a REIT or something like that? What can we do with this money besides letting it sit in Capital One? So we talked about a couple of things, and we have come down to 4 places where we're going to park this money. I am going to share my screen in a few minutes, because I want to show you like the process behind this and the math. But I wanted just to let you know. So the first 2 things, okay, so they're kind of similar. So the first 2 places we're going to park some money is in 2 ETFs. Okay, so these are covered call ETFs. So if you don't know what call or puts or just options in general, so basically when you put a call in, basically that means that you are betting that the stock will go up, and you will take the gain if it does go up. If you put in a put or a put option, and you are betting that the stock or the ETF or the fund or whatever it is you're betting against will go down, and if it does, you collect that profit. Well, the ETF does a lot of that work for us, because it is actively managed, number 1. Number 2 is that we don't have to really watch the stock market in terms of seeing if the stock is going to go up, so maybe we should put a call into it so we can collect that profit. If the stock or fund is going to go down, so maybe we should put a put in it, and all the other kind of stuff. We figured we'll get an ETF, and we'll get 2 reputable ones that I've done extensive research on, and just park our money there. Keep in mind, guys, this money is not earmarked for retirement. We do not want this money sitting in a 401k, though we cannot do that anyway. That's through an employer. We do not want this money in any type of IRA. That's Roth, that's spousal, that's traditional. Again, this money is supposed to be almost like bridge account money. And bridge accounts are basically accounts that you use from when you retire early, or maybe you want to just take a sabbatical. Maybe you just want to go down to part-time, but money that is so liquid, and liquid just means you can access it easy. So we want this in a bridge account we can kind of access when we hit early retirement at 42 and carry us until we hit 59 and a half. Again, and I know it's a lot of information in this video, but again, you guys are seeing some of the method behind the math of this. So putting this money in a bridge account, which usually are brokerage accounts as well, it's accounts that you can kind of put money into and take out without any type of tax penalty, if that makes sense. So we wanted to make sure this money goes where we can pull it if an opportunity came up. We want to be an investor in something. Maybe the housing market crash or something, and we can pull this money out and put it down on the house. And that's what we're trying to do with this money. So again, let me go back. So the two ETFs that we're going to put this in is JEPI, which is ticker symbol JEPI. That is the JP Morgan Equity Premium Income ETF. And the other one we're going to put it in is ticker symbol QYLD. And that is the Global X NASDAQ 100 Covered Call ETF. And also keep in mind that like covered call ETFs are really, really great if you believe the market is going to kind of be struggling for a while. And I do believe that the market is going to be struggling for a little while. Again, I'm going to watch this and keep an eye on it. I do my portfolio updates and I do my net worth updates. So I check the accounts twice a month. I actually check them a little bit more, but again, I check them twice a month and I make videos about it. So we'll be able to follow this process together, you and me, to see how this comes. The other two positions that we're going to put some money in is, oh, of course, y'all know ticker symbol O, Realty Income. That's the OG. You guys know we were putting some in there. And SCHD, which is the Charles Schwab US Dividend ETF. So I'm going to share my screen. You're going to see like how many shares we're thinking of putting into each. I'm going to share dividend growth percentages with you. And I'm also going to share how much we are projecting to receive every month by putting $50,000 into these four places. Because the idea is, okay, if we are going to net, at the end of the day, about $275, $280 on a rental property because of the high interest rates. Could we get more than that just putting the money into the market and my husband and I not having to do a whole lot of work in terms of managing a third rental? Now, keep in mind, we love real estate, but again, as a business, when it comes to numbers, $275,000, I keep saying $275,000, $280, okay, is not a lot to net when the interest rates are at 8%. It just really isn't, considering all the work that goes into real estate, which is why we have like the $500 minimum threshold we want to walk away with. So we're trying to see, could we actually get more than $280 a month by maybe putting it in dividend paying funds and securities. Okay, so I'm going to share my screen, so don't forget to like, share, subscribe, and let me share my screen and show you all of the numbers. Okay, so let's do this. All right, guys, so I'm here, I'm sharing my screen. Before I show you like all the deets in terms of what we're investing in, well, I shared that, but like how much shares and all of that, I wanted to bring you to our Robinhood portfolio so that you can see what it's doing today. Now, I did transfer $10,000 over here. Well, $3,000 is still incoming. I did two transfers, one for 7, one for 3. So I did invest quite a bit of the $7,000 that got here first. And some of these, you'll see these more in our portfolio update, but we did get 100 shares of Realty Income. We have 100 shares of QYLD. I will show you more of this in a second, but let me switch on over to, not that one, here, right here. So let me move my face. So I did tell you guys earlier in the video, like the 4 securities or stocks and funds that we were putting that $50,000 in. And here's some more details. So I will try to zoom in so that you can see this better, even if you can't see my face. But we have JEPI right here first. And you can see that the dividend yield on this is 8.84%. They did not allow me to put growth in because it's this particular ETF is a little weird, but this has a great track record. And so I know this has some great growth. The current share price right here is $56.12, and our goal is 400 shares. I already bought 200. You will see a screenshot up on your screen of that. I'm trying to buy some now when we got paid, and then I'll buy the rest at the end of July. I don't want to just dump all the money in at once, but rather just kind of like dollar cost average, if that makes sense. But the total would be $22,448-ish about. Next is QYLD. I talked about that earlier in the video. The dividend yield is 14.20%. Again, guys, these covered call ETFs do really well when the stock market is like kind of shaky or wonky for a while. And like I said, we expect it to be that way. And we're trying to create income with this $50,000 to see if we can actually, like I said, beat that $280 net that we would have gotten with a third rental because of the higher interest rates. If we can get more than that, just investing the money in the stock market. And we do less work because, you know, with the rental property, like I said, it's passive for the most part, but there are times when you do work and it's a lot of work when those times come. So we see QYLD ticker symbol, 14.20% dividend yield. So a fantastic dividend yield. Dividend growth is actually really good as well at 9.4% interest. If you want to know more about the dividend yields and things, this is why I created the Patreon group for the dividend group members. It's included in the VIP tier. Just read the instructions there. But again, guys, really, really solid stuff we talk about over in that group. And if you have a company, I will actually research the company in that live for you guys, if that makes sense. So we see QYLD, the current price is $17.75, and we want to get 400 shares. That'll cost us about $7,100. The next security we're going to put this $50,000 in, or some of it, is in O Realty Income. You guys know I had to do some O Realty Income, and O Realty Income and SCHD are like a little bit safer, right? So we're not just putting all of the $50,000 in, like, you know, 2 ETF covered call riskier securities. We're also putting it in some safe places that also pays a dividend. So like I said, O Realty Income, their dividend yield currently is 4.25%, and their dividend growth, which we love to see growth, is 2.23%. So a little lower, but it's more stable. It's currently at $68.70 at the recording of this video. We want to get 150 shares with this $50,000. So that will cost about $10,305 ish, because the market could change. That's why I'm saying like ish. SCHD, which is the Charles Schwab dividend ETF, that dividend yield is about 2.42%. The dividend growth is absolutely amazing. And Charles, this SCHD is probably the safest out of all of these because it has like solid companies in it like Coca-Cola, Microsoft, things like that. But we do like JETP and QYLD because we can get more income for it, if that makes sense. But coming back down to SCHD, and now none of this is financial advice. Y'all know I have to do my spiel. I'm not a financial advisor, okay? You do your research, but at the end of the day, you see our money growing, and I want to make sure that your money can grow as well. So the current price for this is $71.19. We want to get 130 shares, so that will cost us about $9,254.62 ish. Okay, so all of that is about $50,000. Now coming down here, I love me a good calculator, girl. I love me a little calculator. So I put slower for growth because, and this is factored in up here, this is what this 5% is for, because I want to make sure we're just doing it as, you know, safely and as conservatively as possible, right? So this, when I click done, and you're going to see how much we're expecting to get from that $50,000 for a year in terms of dividends, you guys are going to see that this is just for like 5% growth. Now we expect about 10% growth in the next year. Yes, the market will come back. It always does. And investing this $50,000 now when the market is red, I cannot even imagine what it'll be when the market comes back. But again, the price growth slower at 5% to be conservative. We're not going to put anything invested extra per month because I want to see just from what the $50,000 can do by itself. And if we put enable DRIP, which is dividend reinvested, I'm not going to worry about dividend income tax or investment calculation length because I don't need to do all that. So I'm going to click done. And then if you scroll down, you see it right here. So look at our calculation results. The dividend yield on average from all of these combined is 5.52%. Our investment return, we're looking at about 17.92%. We're looking at an annual dividend income over the next 12 months of $4,105.08. So I'm going to divide that by 12 to see exactly how much that would be per month to see if we can actually beat that $280. Like if we would have gone ahead and bought the third rental at like an 8% interest rate, what we would net. So let me put this $4,105.08 divided by 12 months. That's $342.09, okay, that we can make just by investing this $50,000 versus buying a third rental at a crazy 8% interest. So now you see, like, okay, from an investment perspective, it's better to actually invest this money in dividend ETFs and stocks versus getting a property, because we're walking away every month, not counting any other dividends we may receive in our other positions, just from this $50,000, $342.09 for the next 12 months. Insane, okay? Our targeted dividend income, so by the year 2025, so that's in 3 years, we should get around $5,774.24. That's just from growth, that 5% growth. But again, I expect it to grow a little more than that. Maybe not 15%, but probably like 7 to 10%. And that means the total dividends that we'll receive for that whole period, okay? All 3 years, a whopping $17,597.37. So again, this targeted dividend income, we should receive $57.74 in the year 2025. But total from 2022, 2023, 2024, 2025, almost $18,000 if we don't put a single cent more in these positions. So that's why we are investing the money. Again, a little longer of a video, but I wanted to really make sure I go over the numbers with you guys. So 79.6% of this $50,000 is going into ETFs, and 20.4% is going into REITs. So again, we really like it. You can see our projected growth down here. This is like scary amazing, okay? Like by 2025, they are projecting, if we get our dividends reinvested back in, this $50,000 will turn into, I hope you guys can see that. Let's bring it down here. $76,521. Like, now you see why I love investing. Now you see why I'm always looking at the numbers. Now you see why I track everything and I'm always researching, because sometimes there's a better way. Would we have wanted a rental property? Yes. Sometimes the math don't work out, and it's better to actually put your money elsewhere where you can do less work. So we're going to collect our $342 in dividends from this $50,000 every month, in addition to all the other dividends that we get, and don't have to worry about something breaking on a property or anything like that. Again, because the interest rates are so high. So next year, if the interest rates drop, you better believe we are going to be using that bonus next year to getting another property. But in the meantime, we'll just sit back, relax, and then collect our $342 in dividends. So that's the video, guys. That's the video. I was doing my calculations on this phone. That's the video. I hope that you guys enjoyed it. Don't forget to like, share, and subscribe. Leave me some questions down below. Thank you guys so much for watching. That's my phone. Thank you guys so much for watching. And until next time, y'all already know, I'll see you in the next one, okay? Have a good one. Bye-bye.